When the Monetary Policy Committee meeting of the Reserve Bank comes around every 2 months, it seems that the whole country becomes obsessed with interest rates. There's a lot of speculation in the media by economists in the build up to the big decision. Will the Reserve Bank cut rates? Will they remain sideways? Will they even hike rates? And most people that I hear from tend to want interest rates to be cut. That's first prize. At worst, they want them to stay the same at currently very low levels by historic standards. There's very few that I hear from in modern day South Africa that want interest rates to go up. There is a more silent minority. It's often older people living off interest income, and they're not always so excited about these low levels of interest rates in modern times. It's no wonder. If you have a fixed deposit of some sort and you're earning interest on it and you're trying to, at least in part, live off that, back in the 1990s, 7% of the whole household sector's disposable income was interest income. These days, it's about 3%. So it's deteriorated for those savers and those investors in these interest-bearing assets. Now, but even for the people who want rates to go down because they're indebted or because their sector is indebted or because they want to see credit-driven borrowing and buying of homes surge, are they wishing for the right thing? I guess that's the question we've got to ask. Well, I think in the short term they are wishing for the right thing. As interest rates go down, there's normally some sort of acceleration in the demand for home buying, the credit-driven component of demand at any rate. So they probably are spot on the money in that regard. But in the longer term, if we look at the bigger picture, are we not wishing for the wrong thing? Do these things not come back to bite us? And I say that because let's go back to 2001. Interest rates had started to decline rapidly as the Reserve Bank changed its approach from 25.5% prime back in 1998, and by 2001 down to 13%. In 2002, we had 4 percentage points worth of interest rate hikes. That's almost unthinkable these days. It would cause immense pain and suffering if it happened. But we had 4 percentage points worth of rate hikes. Prime went from 13 to 17% in 2002 in 1 year. And yet that residential property market, which was so strong at the time, benefiting from those initial rate cuts post-1998, hardly missed a beat. The party went on. The strong residential market went on from strength to strength almost. Really hardly skipped a beat in 2002. Why was that? Well, there's a very simple answer, I believe. Back at a stage in 2002, the household debt to disposable income ratio was around about 51 to 52% at one point. 52% of disposable income. That's what the overall, not the interest payments, the overall debt burden was. Nowadays, we're looking at above 75%. And therein lies the big difference. That is why, because of this much bigger burden of debt on the household sector, fueled over the years by lower and lower interest rates. The lower the interest rates get, the more we borrow. And up goes the debt to disposable income ratio. So we've made ourselves more sensitive to interest rate moves. And so we're at 7% prime rate, not 17% as we were back in 2002. And we're hoping that we don't get a 25 basis point interest rate hike, let alone 2 or 3 of those, because the household sector has become far more sensitive to interest rate hiking today than what it was then. And a big part of the reason is because we've just merely become highly indebted. That's all lower and lower interest rates really do. They just fuel increases in the indebtedness. And in the end, that high indebtedness just becomes a drag. It also fuels at the same time, I believe, lower savings rate, or contributes to lower savings rate. And this is one of the key issues in South Africa at the moment, that our savings rate since the 1960s and the 70s and the 80s and the 90s, it's broadly been on a downward trend over a few decades. Not only the household savings rate, but the government savings rate and even the corporate sector savings rate, the overall savings rate of the country. Savings is required to fund fixed investment, and fixed investment is a key driver of long-term economic growth. So you can decimate your savings rate, you can go for a nationwide consumer culture, and that provides short-term, and you can borrow to do it, and it provides short-term economic growth. But in the long term, a lack of savings, a lack of fixed investment starts to hamper your long-term economic growth as a myriad of infrastructure buckles under the pressure or doesn't expand to keep up into its capacity to keep up with what's needed for economic growth. So low savings rate, part of the contribution to weak economic growth. If you don't have enough savings for fixed investment, if you want to increase fixed investment, you run a current account deficit and you need foreign capital inflows to fund it. And if those foreign capital inflows don't come in that abundance anymore, you have a problem. It's very simple stuff, really. We just can't live on ever-increasing loads of debt. So the low and very easy accommodating monetary policy, I know it's been done this time around to soften the blow for a big crisis last year, which wasn't of our own making. And that's fine. It does provide a short-term cushion. But in the longer term, the levels of debt that have been run up by the household sector, by the commercial sector, by the government sector, ultimately become a drag on economic growth. And then in the longer term, you don't have a housing market that's booming. You don't have a housing market that's necessarily healthy. Because in the longer term, when you look past short-term interest rate moves, property markets, housing markets are driven by growth in disposable income, growth in purchasing power, people who have jobs, people who have incomes, an economy that grows and are able to afford loans or pay cash. That's what drives the long-term prospects or the long-term performance of a housing market to far greater levels on a sustainable basis, not short-term interest moves. So I guess in a nutshell, as interest rates cycles go ever lower since the late 1990s and bottom out at lower and lower and lower points, I guess in a nutshell, we need to be careful what we wish for.